Hey, can you put it so I can share my screen? I've definitely got some good
Yeah.
data, charts,
Yes.
visuals to share with your audience.
Yes. Give me 1 sec. Give me 1 minute. Let me tidy up some
Awesome. Yeah,
things.
take your time.
And perfect. Okay, there that goes.
Hi, Ed. How are you?
Myself here.
Doing great. How you
Good.
doing?
Fine, thanks. Where are you located?
I'm in Long Island, New York.
Good stuff. I'm down in Palm Beach, Florida. Brian, where are you? I don't remember where you are.
I'm in Birmingham,
Okay.
Alabama.
Yeah, Birmingham. We do a lot of business there. Good
I know
stuff.
you do. I know you do.
Good
Hey,
old.
we have an offer on a property there right now. Can't tell you which one though.
Okay, don't tell me which one.
Good idea, Ed. Don't tell him.
Okay, so share screen. All panelists. Here we go. Yep. Can you start?
Okay.
Start
Yeah, it works.
sharing. All panelists. Perfect. Yep. And guys, it's going to be kind of round robin style. There's going to be some folks coming in. I know Tim Bratz is coming in early and he wanted to get some time, and Mark Evans wanted to get some time as well. Jason, obviously you're a huge part of this because you're so entrenched in and all over the country, what's going on. So super excited to hear from you as well. So we're just going to kind of do round robin style. I hope that'll work for y'all.
Cool. Yeah, no, panel discussions are great. I just want to make sure I can show you some visuals because a picture says 1,000 words.
Yeah, no, there's no doubt about it. Ed, it's good to see you. We're going to, when Eric hops on here in a second, we're going to be obviously talking about why we're doing this. And so Jason, we're going to have about a 5-minute intro, just kind of lead us
Awesome.
into what it is we're doing. But Ed, we're getting ready to hike the Lake Tahoe Rim Trail.
I know, a little
miles.
walkabout.
Oh,
How
you guys
are you
are
feeling?
lucky. That's going to be awesome. Wow.
How are you feeling, Ed? You feeling ready to go?
Feeling nervous. But hey, I'm up for it.
Yeah, it's definitely gonna be something. It's gonna be something you'll never forget for sure, one way or the other. But yeah, as soon as Eric gets in here, Eric Upchurch, kind of Jason leading this mission of us hiking the Rim Trail to raise money for
awesome
for veterans. Yeah,
that's a great cause. I mean, man, the veterans just do not get a good deal. It's not fair. So that's great that you're taking care of them.
Yeah, for sure. Well, Jason, why don't you? We're not even really officially started yet, but we've got some folks in here. Might as well, and we're YouTube live, and we're about to be Facebook live here in a second. So, why don't you introduce yourself real quick?
Sure. I was actually going to ask if I could have a moment because I jumped on. Ed, I'm not quite ready. Okay, so Ed, I'll let you guys talk. I'll be right back.
For sure.
Okay?
Ed, why don't you introduce yourself?
Yeah, sure. So I'm from Long Island, New York. Bought my first multifamily in 1980. But then I went in the wrong direction for a number of years and had a full-time job in television all my life in New York City and on the back end of the camera, not the front end. And about 6.5 years ago, I decided to go full-time into real estate. Did that, got into the flipping thing. That was another job after a year and a half, got into multifamily, never looked back. And, I've done about 24 syndications that's where I'm at. I do in the Southeast, Midwest and Texas. And we're still bullish right now. We're being very cautious out there though. Things are changing.
Yeah. So you said earlier you got some stuff going on in Birmingham. Is that multifamily?
Yeah, we have an offer on one there,
okay.
a real nice property. Yeah, we'll see how that goes. We're not in best and final or anything yet, but hopefully we will be.
Very good. Well, cool. Mr. Roop, how are you? You with us? Let Richard join us here in a second. Jason's on, and I know Eric's going to be headed this way. And for all of you who are joining us, we're excited that you're here. And it's for me, I'm in the central time zone. It's 6:00 on the dot. And we're going to probably go for at least 2 hours. We may end up going longer. But just I want to kind of give a little bit of a setup real quick. I like to do the current state of real estate. I've been doing this for ever since the pandemic hit. So ever since March of 2020, I've been doing some sort of current state of real estate. Do this once every maybe 6 months. I think the last one I did was about 6 or 7 months ago, and want to catch everybody up with what's going on. I think that right now some interesting things are happening with interest rates, and we're seeing all across the country that things are slowing down. I think it's pretty evident. So I want to we want to kind of share some great information with you from a rock star panel that we have coming on. There's going to be joining us. Jason Hartman's already here, who's got some data for us and wants to share his screen, is going to give us some really good hard data about what's going on in, and when I say the real estate market, it's easy to say that, but there is really no such thing as a real estate market. There's segments. And so I'm sure I'm going to ask Jason about those kinds of things. We got Mark Evans here. Tim Bratz is in the house. Mr. Evangelisi in the house. How we doing, guys? Hopefully we're doing good.
Great, man. Yeah. Appreciate you having us.
Man, I'm so excited that y'all are here. Just going to give a quick intro. All that being said, guys, you're here for a reason. We're going to share some great information with you over the course of the next hour or two or so. We'll go in as long as I got panelists here that want to talk. But the reason we're here today, and the reason I'm here tonight, and the reason we're doing this is because there's something that's near and dear to my heart, and there's something that's near and dear to the hearts of many. There's actually 12 of us who are about to set out on an extremely difficult, challenging 170-mile hike. We're hiking the Lake Tahoe Rim Trail, the entire thing, all the way around in 9 days. And we're doing that starting on Wednesday next week. So we're less than a week away where we start this thing. And we're doing this to raise money and raise awareness for homeless veterans. Right now, there's a company that there's a nonprofit that we've partnered with, and they are building tiny home communities in specific pockets of the country to hopefully put an end to homelessness for veterans, and which is a solvable problem. And we can actually put an end to this. And what we're doing is we're raising $1,000 for every mile we're going to hike. So that's $170,000 that we're trying to raise. We're up to $121,000 already, and we've got less than a week to go. So my ask of you guys, not just the panelists, but everyone who's watching, listening to this, our ask is, and I'm going to put the link in the chat, but my ask is that you donate. And even if it's $5, $10, $20, whatever you can afford, hopefully it's more than that. But if you get some value out of tonight, and even if you don't, do it for the people who allow us to be free in this country. I come from, aunts, uncles, parents, grandparents, great-grandparents. I feel like my entire family has served in some sort of branch of the military at some point, and we wouldn't be here without them. And so we want to try to do something back in return. I think a lot of us are put in a position to where we can do something. And if you can, we're going to ask you to do that tonight. But with all that being said, I'm going to put that link in the chat here in a second. Shut up. I want to kind of turn this over to a couple of the unbelievable real estate rock stars that we have in the room right now. And Tim, I was talking to you yesterday and earlier this morning about kind of giving you some time early. I wanted you to kind of be the first one. And I would love to just let's just break it wide open and just ask you the $1 million question, elephant in the room. It seems like things with the real estate industry, it seems as if things with interest rates and inflation seems as if things are slowing down. From a multifamily standpoint, what say you, and where do you feel like we're headed here in the next 3, 6, 12 months?
Oh, man. Well, first of all, appreciate you putting this together, man. You got a hell of a lot of influence to gather this many players in a day. So congratulations to you, man. I got a ton of respect for what you got going on, and a ton of respect for everybody else who's on here. So some very good friends of mine are on here. But yeah, I would say, listen, dude, I don't think I think everybody was aware enough of what happened in 2007, 2008, 2009, where it still burnt into a lot of people's heads, and they're trying to go back and forth. And is this like that? Is this a bubble? We don't know. nobody's got a crystal ball, right? So, but there's obviously indicators that say things are slowing down, right? In Charleston, South Carolina, in the residential market, 6 weeks ago, we had 800 houses on the entire MLS. 6 weeks later, today, there's 1,700 houses, right? There's still way more demand than there is supply, but that's on the residential side. And I think these interest rates rising are going to affect residential real estate far more than it's going to affect rental real estate, just because, obviously as interest rates go up, your buying power comes down because you're spending more money on paying interest than you are paying principal. So simple economics on that side. On the commercial side, and what I'm seeing in my apartments is it's definitely spooking some sellers, right? They're a little bit more engaged. They're a little bit more open to looking at some offers. They're a little bit more accommodating for creative finance as well. In order to, I see they're not really coming off their price point, but they're willing to be more creative on their financing strategies, right? I think they're still a little bit in denial to the point where like, hey, listen, I'm not going to come off my price point, but I'll carry back 10% in a secondary position or an unsecured or as an equity investor in the deal instead of, coming off my price point, and as I've been doing that with some of my properties that I'm selling. We've also seen a few buyers that have come in and got spooked by interest rates and fallen back or tried to retrade. And that's okay. Like in my mind, well, let me stick with the analytics for a second. So that's what I'm actually seeing, right? On properties that I'm selling right now, we're seeing, buyers come back and a little bit spooked by interest rates, and I'm getting a little bit more creative on the structure in order to still make a deal happen. On the buying side, because I'm still looking to buy, we're definitely paying attention to it, and we're utilizing the whole scenario of interest rates rising and uncertainty in the market in our favor while we're negotiating deals. So we're going to sellers. We're saying, hey, because of the uncertainty in the market, because the interest rates rising, I can't pay you a 5% cap rate for your building anymore. I need to buy it at this, and here's the reason why. Or maybe we can structure it in another way where you carry back some financing at a very low interest rate. So that way my blended cost of capital, the blended amount of money that I'm borrowing from the bank, and then I'm borrowing from my investors or the seller, ends up getting to a point where I can make it make sense, right? Dude, I think even though interest rates are rising, typically cap rates rise with those, which means values would come down. But what you're seeing with so much inflation, and they're claiming it's 8 to 10%, right, year over year. The reality, it's probably a lot more than that. And nothing tracks inflation better than rental real estate. So I am very confident. I'm still buying real estate. I have zero concerns. Obviously, I'm paying attention to how I structure it, what my debt looks like. I'm setting proper expectations with my investors where maybe I'm not going to cash them out in 24 to 36 months. And I'm pushing that timeline out a little bit longer and saying, hey, look at like 60 months, right? And guess what? If shit hits the fan, then it might be 72 months or whatever. Or we're going to be paying attention to interest rates. And if there's a lull in the market and rates drop, then we will refinance at that time. But dude, I'm a big believer in that there's deals in every market, right? Like there was opportunity and obstacle 10 years ago. There's opportunity and obstacles today. It's just a different type. 10 years ago, deals were everywhere and money was nowhere, right? So you had to pay more for money, but you got smoking price on deals. Over the past couple of years, deals are nowhere, but money's everywhere. So you get paid less on money, but you have to pay more for the deals, right? And so it's just a balancing act. And where are you with the market? And I think plugging into groups like this, right, getting insights from multiple people who are active in the real estate space and staying in communities like your mastermind, and know a bunch of these other guys have masterminds in here, dude, that is the key, right? That's the key is making sure you're plugged in and making sure you're having the right conversations, high level conversations of people who are not emotionally making decisions, and instead they're making decisions based on fact. You're muted.
Thank you. Before we get responses to what Tim just said, thank you for calling me out. That's just so quick. Appreciate you doing that. Tim, I want to give you an opportunity real quick. You mentioned masterminds. You mentioned some things that you've got, or that we all kind of have going on. Can you briefly talk about what it is that you have going on as far as like your mastermind and how people might be able to get involved with that? And also maybe type that into the chat where everybody can see that, like a link or whatever.
Yeah, listen, dude, I'm here to give value. If you guys want to check out my mastermind, it's legacyfamilymastermind.com. And you guys are more than welcome to check it out. But like, I'm here to help you out. So
I get it.
Help you raise some money. So I don't really want to promote, but if you guys have interest, hit me up on Facebook or social media or something. I'm happy to sharing that stuff with you.
Tim's one of the few that I would promote. So I'm going to do it for him. He's got a wealth of knowledge, and I highly recommend that you guys check out what Tim's got going on. Anybody on the panel have a response to what Tim just said?
You know, I think everything he said is right on. And we are in a market where a lot of people think, well, inventory has increased, and it has. But I asked the question, which I call life's most important question, compared to what? Inventory was so low, I mean, just insanely low to start with, that what we've seen now does not even come close to satisfying the market. The way we've got to look at inventory and supply and demand in the housing market is look at it like a sink, right? You know, you've got the faucet and you've got the drain. And so you fill the sink up, and if it's at the mid-level, which is a normal inventory level, and you put the faucet on and there's more inventory coming in and there's not much going out because not much is selling, then you've got a problem. You move into a buyer's market, right, where the market softens. But the sink had like a little inch of water at the bottom, right? That was the inventory we started with when rates were at a 5,000-year low, which is quite literally how low they were. They've measured interest rates, I kid you not, for 5,000 years. A great book on that by the late David Graeber called Debt, the First 5,000 Years. Really good. And so we're coming off a point with just historically low inventory levels. So it's going up a little bit, but it has a long way to go to get to the midline on that sink, which is normal inventory. In fact, inventory has to increase from where it is now by 300 to 500%. Think about that. 300 to 500% increase just to get to normal. Okay, so we're far from a bubble. We're a long way from a bubble, but one will come eventually. There will definitely be a correction eventually.
Well, Jason and Tim, where is the difference? Just so people who might be watching this and listening to this can understand. Tim, you're attacking this and you're coming at this from a multifamily standpoint, obviously. And I think Jason, you're
residential
coming at it more from a single family. Where is there such a wide gap that we can't kind of talk? We're kind of talking in pretty broad terms anyway. And we're not even talking about market specific, area specific. Where's the gap, and can some of these indicators that both of you have mentioned, is there some similarities, and is there just they don't even connect at all in some ways?
Well, everybody needs a place to live. So if it's in one of Tim's apartments or in one of my houses, you know, either way, they need a place to live. I mean, obviously, you know, if they have more money to spend, they're probably going to get a house, or if they have a growing family. But everybody needs a place to live. Housing is a universal need, and that's why I love it. It's my favorite asset class.
Well, they need a place to live, and that's either own or rent.
Right.
So there's that two aspects. I think less as things. I think economic wise, things are going to get really tougher for buyers and sellers.
Yep.
Inventories, yeah. And so that means financially. So people will want to downsize, people want more affordability, but they're also going to get stuck because of the lack of inventory. Where do you move to when you want to move, right? And getting loans, interest rates affecting the normal buyer going out there getting a loan. So one of the opportunities is to provide housing for people that need homes. So buy and hold and plan on. Jason, would you think in an environment like this, do you think rents go up?
Yeah. So people that own a lot of real estate and are landlords and have 30-year fixed rate mortgages locked in, they actually like high interest rates because it's great for them. It puts upward pressure on rents. I mean, think about it. People have three choices. They can buy, they can rent, they can be homeless, right? And once I said that at one of my live conferences, and someone said, no, they can live with their parents, millennial generation. And, so higher interest rates force people to stay in the renter pool. And so you're absolutely right. It's a really good point. So if you're an investor, either way you win, right? Sometimes you're in a capital appreciation market where you have low interest rates, high housing affordability, and prices are rising through the roof. We've seen that for the past few years. And now maybe, but not yet, we're moving into more of a yield-oriented market where you just see rents increase so much and you're just milking that yield. So either way you win, just adjust your strategy.
I think we're assuming demand's still here. I think demand's messed up right now. We're talking about supply demand.
Yep.
I think the demand is weak. I'm seeing it. I'm in a pretty high end area where I live, and it's already happening. You got to look at a bunch of metrics too, right? It ran up 100% in 8 months, and they're listing it for 20% over that even today. And people are just cooling off. There's a cool off effect that does happen in these kind of markets.
Yep.
So people are like, they'd rather just sit and wait and let's see what happens, because they don't want to be the dummy that buys at the top.
Right.
And now they know that's happening right now. I mean, it is literally happening in my community here in Florida, where people are flocking like crazy, and people are like, literally like, I'm going to wait for 6 months. We're going to see what this market does. 4 million, I can get it for 3 million in 6 months from now, blah, 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 blah. So like, it's there is a demand, supply, there is a lot of supply and it is increasing, but also demand's weakening for a minute. I think it's just going to be a cool off second.
Right. And Mark, it makes a big difference, what segment of the market we're talking about, obviously, right? Low priced entry level properties, they haven't built them in frickin' 14 years. I mean, the whole nation has gone 14 years without builders building entry level housing. So in that segment of the market, which is mostly what I was addressing, people don't have a choice. They just need a place to live. They got to live in an apartment, rent a house, or buy a house. That's it. No other choices. The oldest millennials now are not kids anymore. They're 41 years old. Okay. The youngest millennials are 26. So, talk about prime home buying years. And it's a struggle for a lot of them because they got a mortgage called a student loan, but they just didn't get a house included with it. It was a very raw deal. And a lot of them got useless degrees that no one's hiring. I mean, I haven't noticed any help wanted ads for feminist studies. I just never see anybody hiring for that. And, so it's definitely a struggle for some, but you can still hedge the interest rate really nicely. I mean, even with the higher rates, you're still at one of those rare times in history. And it's only happened like a few times over the last, since the 40s, right? Where the stated consumer price index inflation rate is actually lower or higher than the 30-year fixed rate mortgage rate. And right there, you're just getting paid to borrow. And people are figuring that out, that it's negative interest rates. So,
but even then, I know, Jason, you could probably add to this, but the consumer price index is probably,
a scam.
It's not the real measure of inflation, right? Because I'm in South Florida also. Rents here in South Florida went up 30%. Like our apartments that we have here and our houses that we have here are valued like exponentially way more than we ever thought possible, just because the rents went up so high. Am I going to bet my investments that's going to happen again next year? No, I mean, I'm not going to bet on future things happening, but still, if you factor a real inflation rate of 20-30%, even at 7% mortgage interest rate, you're really still borrowing free money. Like, you're getting paid to actually borrow.
You're getting paid more. The higher the inflation rate is, the more you're getting paid to borrow. Like, think about this. They tell us inflation's 8%. You can borrow at 5.5 or 5.25. You're getting paid 2.5% to borrow. But if the real inflation rate is more like where I think it is, and I bet all you guys will agree, 15%, then you're getting paid 9.5% to borrow. And you get a tax benefit kicker because the interest is obviously deductible. That's 2.2% at 40% combined state and federal. So you're getting paid 11.7% to borrow money. That's if you keep a property vacant. Like, in theory, I know there's other expenses, but by and large, right? I mean, it's dysfunctional. The whole system is a house of cards. It's completely dysfunctional, but take advantage of it. That's all I can say.
And we're still seeing, like, here in South Florida, I mean, man, like, all our properties, if we price them at a decent price, I mean, we're getting 20, 30 buyers calling us within a few days. I mean, properties are selling for over market price. Buyers are willing to pay, do appraisal gap contingencies where it's like, man, I'll lock it up, just even if it appraises for 10K less, like I'll do it, don't matter.
And is that like this last month still?
This is like today.
Right. Okay. Got it. Yeah.
We just listed a $1 million condo in Aventura, and I got a full price offer today, like same day, like ready to go. He's like, I don't even need to see it. No contingencies. I'll just fucking take it now. Yeah. I mean, but our deals, they're still flying pretty fast, which is nuts.
Go ahead, Richard.
Yeah. My question, because I bought my first 2 no money down properties in 1987. Did really well in Hawaii when the Japanese had their housing bubble. Had all my equity tied up in this because I traded them up to it for a luxury home overlooking the ocean, and then I saw the market turn, and I had to quickly save my equity and get out of that. The last market meltdown, just before 2008, when we were in this bubblish arena, there was high speculation. Hey, invest in these condos; they're going to appreciate over the next year and stuff. How many of you guys are seeing speculation, or are you not seeing speculation? Because I think high speculation is an indication of a top.
So like in Florida, I can speak to Florida. Like in Florida, several years ago, you were seeing that because they were overbuilding in Brickell and, in the whole like Miami type area. And you were seeing a ton of it. I lost like $180,000 on a deal like that we had solid comps for, but there was so many actives in the building that it just price just got forced down, and we ended up getting our ass handed to us on that deal. But today is the complete opposite. Like if I would have been able to hold on to that deal for like 2 more years, the property appreciated because now there's no listings. Like I'm not as seasoned as some of you guys here are by any means, because I haven't been in a previous market cycle. I got in like in 2012, but I can tell you from 2012 to 2022, I've been doing this for almost 10 years now. I have never seen this in my career where we're comping a house and there's no actives. There's always been actives to look at and know, okay, well, my sales, like, are there actives telling me that things are going down that I need to pay attention to? Or if like, I'm thinking a house is worth 300, like what are the actives priced higher? Are they priced lower? Or are there actives at 300 that haven't been selling? So like, maybe I should adjust my price. There's just no actives now. So every time
but you just take the last comp and add 50%. Just kidding.
Guys, this is a good chance to just pause for 1 second and introduce. There's a couple new people who've popped in. Gabe obviously is one of them. Gabe Garcia, thank you for coming in. Joe Evangelisti, Tag Thompson, Nathan Brooks. Guys, we appreciate y'all joining us. Nathan, can you hear me? I want to get you on here to talk for a second.
Yeah, brother. Thank you so much. Sorry, I'm having some tech issues. Can you hear me okay?
I can hear you great. Yeah. So I want to ask you real quick. So guys, I mentioned this at the top of the show. And by the way, we've got a ton of people watching on YouTube as well. So say hello to the YouTube crowd. We got some questions coming in from YouTube already that I want to get to. Guys, if you have questions here, you can put them in the chat, or you can put them in the actual question thing where you can raise your hand. We can get you on live. But we're doing all this, guys. The whole reason we're here tonight is to raise money for homeless veterans. That's the whole reason we're here. And Nathan is one of the guys who's doing this hike with us. Nathan of Bridge Turnkey Investments. You guys are, I want to get your take on the real estate market for sure, especially where you guys are building to rent. You're doing a lot of turnkey stuff. But Nathan, talk about the cause first. Talk about what we're doing, why we're doing it, and what we're hoping to get out of it.
Absolutely. Thanks, Brian. And nice to see a bunch of familiar faces on here. And it's a pleasure to be in such an awesome crowd of humans here. But the hike is 170 miles. We're going to literally hike with all our stuff on our back around Lake Tahoe. And I've been working for maybe 3 months now on trying to dial my stuff in. But it's amazing when you start to count those ounces when you put it on your back and hike. Did a little test run, 40 or 50 miles a couple weekends ago, and just, trying to get all that stuff in. But what a blessing it is for us to be able to literally say, let me buy the best gear, or let me buy the lightest weight backpacks and all that stuff, when in fact what we're doing is raising money for people who literally have nothing. And so what a blessing that is, and a joy that is to be able to raise that money. So last time I'd seen that the total was around 125. The goal was 170, $1,000 a mile. And so I cannot imagine we can't solve that problem by the end of the night, or at least get pretty damn close to it. So anyway, thank you again for having me on here, and I'm really, really, really pumped. Oh, I should also mention, about half the guys who are doing the hike with us are active duty or now veterans themselves. So it's definitely inspired by those who are already serving or who have served, and so it's truly a blessing to be able to do that with this group.
For sure. And Nathan, can't thank you enough for everything you've contributed, obviously to the cause of what we're up to. But let's kind of shift our focus back to real estate for a second and provide some value to the folks who are listening, who are watching. You're building to rent right now. So we've been talking about luxury a little bit, talking about, apartments. We've been talking about, what some C-class housing, some kind of lower level housing. What you're still building to rent. You're not scared off by just this little bit of chatter that's going on right now. Just kind of give us your vantage point of what you see. What class of properties are you building? Who are they for? And then where are you seeing that specific segment of the market headed?
Sure. So we operate in two markets. We build in Kansas City, and a lot of those go to, they're both spec, to retail. We have about 35 or 40 active projects right now. We'll do in the 60 to 70 range this year, just for context. And we'll build about 100 in Texas this year. All of the ones in Texas are both horizontal and vertical. We're doing for build to rent, and we're holding everything there. So that's what that's going on. Honestly, interest rates have created some challenges as far as the exits on our projects. I'd be curious to hear what other guys on this call are saying, but as far as the demand from the banks have been as great, we're literally getting phone calls still from the banks, wanting these deals, knowing they're in the pipeline. We haven't had problems getting them rented. We haven't had problems getting appraisals that we had projected. So the primary concern, the thing that we've been thinking about the most, is just on the build to rent side was what those looked like cap rate wise and cash flow wise, and meeting those DSCR requirements, which have been a challenge on some of those projects. And then on the retail stuff, they're just still flying off the shelves.
Does anyone, Joe McCall just joined us, by the way. Thank you for coming, Joe, as well. Does anybody have a kind of a response to what Nathan was just talking about, or wants to add anything to that discussion? Love to, open it up. Joe, we haven't heard from you yet. Either Joe, if you guys want to chime in as well.
Well, as Jason Hartman was talking, I was reminded of something that Mark Evans is famous for saying: data, not drama. Right. And it's so easy to get hyped up and panic and freak out and just, oh my gosh, what am I going to do? And there's so many voices out there saying different things. It's kind of hard to figure out. But this is why I love real estate so much, is because it's not like the crypto markets or the stock market that changes on a dime and immediately next day it's down 500 million%, right? Like, real estate moves so much slower. And that's why it's so important to be involved in a high level network mastermind group like this, hanging out with other successful investors, because you will have time to read the tea leaves. You'll have time to figure out what markets are hot, what markets are good inside the markets. If you pay attention and study it and hang out with the right people, you'll see, okay, well, this area of town was hot 6 months ago. It's not anymore. So I'm going to be focused. It's all about following the demand. And the cool thing about real estate is you can follow where the money is going so much easier than any other kind of asset investment that you could invest in, right? And so that's why I always say, never buy a house that you couldn't wholesale. And if you know what your buyers are buying and for what and where, then that's super easy to find out these days. You're going to stay out of trouble. You're going to stay out of trouble because because you know where the demand is going. And I'll talk about this later maybe, but it's so important now more than ever for investors and wholesalers to be really, really on top of their game with the simple, basic stuff. For the last 5 years, you could get away with being an idiot and make a lot of money in this market, right? But going forward, I think it's going to be even more important to be really good at those simple, basic things. Peter Vexelman and I wrote a book called Brilliant at the Basics. And if you want to be good in this game, it's going to be even more important now to be brilliant at the basic things. So data, not drama. That's what I'm thinking. And if you stay in tune and in touch with other investors, and then be talking to the buyers. There is so much money sitting on the sidelines. I think Jason was saying earlier, or Tim, there's so much money sitting on the sidelines waiting for the market to come down where they're going to be starting to buy properties. You just need to know who those people are, and you'll see it. You'll have time if you pay attention.
Guys, real quick, before we get a response to what Joe, thank you for that. I appreciate that. Data, not drama. I've read that somewhere before. Couple of Mark Evans books that I have on the shelf back here. Guys, I want to remind you, if you have a question, we're here for you. If you're watching this live on Zoom, or if you are in the YouTube chat, if you have questions, we want to answer it. So this is your chance right now. While we got a lot of heavy hitters, if you have questions, we definitely want to answer them for you. Does anyone have a response to Joe Tag? We haven't heard from you. We haven't heard from Joe Evangelisi yet as well. If you guys want to just hop in and kind of give your take on what we're seeing going on right now before we get to questions.
Yeah, I'll talk for a second. It's kind of odd. Am I the only, I know most of you guys through the last few years, but I'm definitely the rookie of the group. I've been in real estate for about 5 years. Is anybody newer than me at it in this group? Most of you guys. I know, Richard, when you said you bought your first investment property, I was in second grade, I believe. So I'm definitely a newbie to the group, and I'm actually a little bit outside of what most of you guys do. I kind of more am on the academic side of real estate from kind of an economic standpoint, and most of what I do now is actually in commercial real estate. So I'm fascinated to hear kind of what you guys are talking about tonight, and would definitely be willing to share thoughts, any questions people might have more from like that perspective. So from a purely, I do have some real estate investment, mainly on the commercial side again, but what I pay attention to is actually more from an academic, economic perspective, and not really an investment standpoint. So if there's any questions, oddly in that realm, I'll be glad to put it out. But really love what Joe had to say. I always love what Joe McCall says about paying attention to the data, no drama. Somebody else, as I was joining, I don't really even remember who was talking about it, but I really didn't catch all of it, but they talked about speculation, which is really what speculation is. Yeah, I think Richard said that. Speculation doesn't mean that you're trying to predict a positive future outcome. That's not what speculation means. Speculation means I'm making investments based off of a purely emotional standpoint. I'm speculating based off of anything other than the data that would point to a positive outcome. And we have seen a lot of that over the last few years, especially from a lot of the iBuyers. And this is always, I was on a panel a week ago that said, Tech, what's a good indicator of somebody to trust when getting advice on where markets are going? And I say, usually my question is, ask them if they think Zillow lost money in their iBuyer program. If they tell you that they think Zillow lost money in their iBuyer program, don't listen to them. Zillow made billions and billions of dollars in their iBuyer program because they manipulated the market. It got to where that manipulation had run the course, but that's why they did it. That's why they were paying so high on some properties, is because they were just manipulating the market for themselves. So I think a lot of people have kind of a smaller concept of what speculation means. And if you zoom back a little bit, if you're an investor, you speculate. It's not possible not to speculate because all decisions are based off of emotion. But if you're doing investment purely from an emotional standpoint, that's a really poor form of speculation. But yeah, love what Joe said about following that data and making sure that your information is accurate and not really based off of. I'm telling you, the worst driver right now the worst indicator you can have is political right now. And it's going to get worse over the next couple of years, but stop listening to politicians. I don't care what side they're on. If there's political motivations behind the people you're getting information from, it's bad information. So anyway, my
That's
2
great.
cents on that.
Yeah. Thank you, Tag. Appreciate you jumping in and sharing that. Does anyone have anything to add before we get to some questions? There's lots of questions.
Yeah, I just want to say something along the lines of like, dude, if I got started in real estate in 2005, bought my first prop like in the trades and stuff, bought my first property in 2009, bought my first apartment in 2012. And I remember I showed up to the party in late 2008 of like, you know what? I'm tired of this analysis paralysis. I'm tired of studying. I'm ready to go and buy a property. And as soon as I showed up to the party, dude, people were running out the back door saying, run from real estate, get out of real estate. And I remember standing there and seeing people reading about the market, seeing what the politicians were saying, watching the news. And there were people, me being at the Real Estate Investors Associations and just trying to figure out how to navigate all this stuff. There were people who this market had happened to that got totally wiped out. Hey, I was worth $70 million on paper and now I went bankrupt. And then there were people who were worth, a couple $1 million that are now worth hundreds of millions of dollars. And I was like, how does the same market happen to everybody? And yet some people sink and some people swim. How is that possible? And I started looking at all the different businesses. And a lot of the conversations that we're having here, some of them are about owner occupied properties and flips and wholesale and stuff like that. And then the rest of some of them are about rental real estate. And I think it's important to delineate between the two of those. But at the end of the day, it's what is your business criteria? What is your buying criteria, your business model on how are you buying things? And I remember looking at the people who were able to swim when the market tanked before, and they were doing a lot of things that might not have been sexy in the moment, but built really long-term wealth. And there were ways that they mitigated risk that other people didn't do, right? Like number one, you guys write this down, anybody who's taking notes. Number one, always buy at a wholesale price, right? If values are here, don't pay this much, and definitely don't pay this much more, right? For value that you're going to bring to the table. Don't pay some seller for the value that you're going to create, And I see people doing it all the time. So buy at a wholesale price. You always want to buy at a discount. That's number one. Number two is create appreciation. Don't speculate, right? That's kind of like number three, never speculate. But for me, I always create appreciation. I force appreciation by putting sweat equity into my properties, right? So that way you can predictably increase the value of these properties. Number three, never ever speculate. That's who gets their legs taken out every single time. Buying here, hoping tomorrow it's worth this much, and then it doesn't, and it comes down. Which leads me into number four. What happens if the value does come down is buying for cash flow. Right? If you buy for cash flow, it's kind of like the lowest common denominator of whether or not a deal will work. If you're buying for cash flow, you can ride out any sort of economic storm. There's always value, even if it goes to zero on paper, but at least you have a tenant who's paying and covering your operating expenses and paying your debt service and putting cash in your pocket. Dude, that's a pretty good worst case scenario, So buy for cash flow, realizing you can fire sale it, you can retail sale it, you can creatively structure a sale, or you can just ride out any sort of economic storm. The other thing that I do is I stick to those workforce housing. I stick to, I wouldn't go below like a C+ class of an area. And I really stick to like that B class, A-, B+ workforce housing, rents that range from like $800 a month to about $1,400 a month is like right in the wheelhouse of where I buy and I rent, because when the market's good, everybody can afford that. And then when the market shifts, all those luxury renters move into more of a workforce type of a housing. So it's very insulated. Paying attention to your financing structures, paying attention to your debt and how that's all lined up. Having multiple exit strategies, right? The more quivers you have, or the more arrows you have in your quiver, the more exit strategies you have, the better quality, right? That quantity leads to quality of how can you exit these properties. And the more you understand about creative financing, and both on the acquisition side and on disposition side are all powerful tools that are going to, kind of make you an absolute ninja as things do continue to pivot. When everybody else is only stuck to, institutional financing, and that's the only way that they know how to fund these projects. When you know how to creatively structure these deals, dude, you're going to be dangerous, and you're going to be able to pick up a lot of properties as the market turns. And that was really important when money was nowhere, but deals were everywhere. I had to creatively finance all these deals, and it's happening again now that money's everywhere, but deals are harder to come by. We're creatively structuring them, and gets us into different types of projects and helps us exit those projects. So focus on those risk mitigation strategies, and I think you're going to be in a pretty safe, good, insulated position, and focus on your economy, right? Mark Evans has a book called The Me Economy. He doesn't give a shit about what's happening out there or what the news is saying. He cares about, what am I doing? And by me creating a better setup for me, my family, and my community, it's going to help everybody, because then I can support more people. I can create more jobs by being a little bit selfish, right? And that's okay, because that selfishness leads to selflessness, because he's got his shit figured out.
Good stuff.
Great stuff.
Tim,
Great stuff. Great
Tim,
stuff.
let me ask you this though.
Thanks, Richard.
A lot of the multifamilies, the bank loans, aren't they on? They're on some sort of like balloon. Is there any concern with having to refinance here in the near future with some of the debt?
Great point. Yeah, totally. So when I talk about putting good financing in place, I'm looking for fixed rates, right? I don't want anything variable. We all know which direction rates are going. So you want a fixed rate. Long-term debt, and that's in two ways. I like a longest amortization schedule I could possibly get. Like, I'll put a 30-year am on everything that I could possibly get if I can get it. Well, Tim, I want to pay off my property in 20 years. No problem. You can still get a 30-year am and still pay it off in 20 years. You just make an extra payment or two per year, and your house is still, or your investment property is still paid off. But what I don't like is having my back against the wall when COVID hits and having this big ass nut that I have to cover because I only put a 20-year amortization on my property. Does that make sense? So making sure you extend out the amortization schedule and extend out the term. So on these commercial loans, we might get a 30-year am, but it might be a 5-year or 10-year or 15-year balloon. And it can be as short as 2 to 3 years and as long as 30 years, but then you're paying a lot more for interest rates. So I think the sweet spot is in that 10 to 15-year range. You get a great interest rate. And at the same time, you're able to ride out any sort of economic storm if that happens. Imagine buying in 2006 and you only had a 5-year term on your commercial loan and you had to refinance in 2011. Dude, you bought at the peak and you got to refinance down here. Regardless of the value that's in the property, it's not going to look good. You're not going to be able to refinance out. You're not going to be able to sell the property because nobody else is going to be able to get financing. And so if you had a 10-year term on that, you could go through the greatest recession this country's ever seen in real estate too, and still come out clean by 2016 to be able to sell or refinance at a value at or above what you bought it at in 2006. So that's what I'm looking to do. And I'm doing, if I can't get that, if I need to get bridge lending or bridge financing, which is like short-term construction loans or something like that, I'm trying to negotiate that with seller financing instead of going to a bank
Tim,
who can kind of have your nuts in a vice.
Tim, Joe here. The question I have is, what about the multifamily investors that have loans that are coming, where the balloon is coming due now, that they have to refinance in this, 5, 6, 7% interest rates? What's going to happen to those sellers?
Yeah, well, hopefully they bought it at a low enough discount. Hopefully they created and forced enough appreciation through value add, and hopefully they're operating it where it's cash flowing. If those things aren't happening, they have two choices. They're either going to default on their loan, potentially get foreclosed on, or have to fire sale it, right? Or the other thing is they're going to have to bring more money to the closing table in order to get a new long-term loan in place. So I've seen it with, dude, what's scary is I've seen it on some of these bridge lenders, like the short-term loans. Usually there's something called DSCR, debt service coverage ratio, which means if you buy something, and the mortgage payment's $10,000 a month, they want to see 1.25% DSCR. So they want to make sure that you're cash flowing after all operating expenses, $12,500 per month. And a lot of the lenders, because just over the past 2 months, all these lenders, all these bridge lenders and debt funds who do like short-term loans like that on value add types deals, all got rid of the debt service coverage requirements because every single loan would be in default right now because they're all variable rates.
That's a good indication of future current trends.
Scary. It's scary that instead of tightening up their lending parameters, they're just getting rid of, they're actually loosening them up in order to make sure they can keep on giving loans. So that to me is one of these indicators of what's that?
Well, what type of lenders are you seeing this with, Tim?
These are like bridge lenders. So like short-term construction lenders, debt funds, things like that.
It's like Fannie Mae and all that shit. They're still they still have their DSCR requirements and all that.
Yeah.
Well, Freddie Mac is actually going down to 1.2 and they're increasing the 35-year AM in cases. Freddie Mac.
For multifamily?
Yes.
Nice.
They don't want to have to report loans as being in default. So that's the way around it.
I was just going to say, they got to loosen up to make something happen. Or otherwise they're in default.
The thing is though, like even if you bought some 5 years ago, even if you paid full retail for it 5 years ago, like it's got to be worth substantially fucking more today than what you paid 5 years ago. So it's like, even if you can't refi, just fucking sell the thing. Like, it would be hard to imagine some type of catastrophe from that.
Well, it was mentioned, it really depends on your investing model, how what's going on affects you, where you live, what type of properties you're buying, how you're funding them. I've learned over the years, over the decades, how to not be controlled by the market, how to protect myself and all of that. And Tim already just said a whole bunch of them. So thank you very much. It saved me a lot of breath. But basically go longer term, long-term, low rate, fixed financing. The main point that I was going to point out here, which slipped my mind, it's been a long day. Owner financing, seller carryback notes, not relying on banks. This has been my mantra since before I created the ultimate strategy in 2008 to solve the problems of the mortgage market meltdown in 2007. If you get financing from an individual, from a seller, and things change, you have someone you can deal with. Mm-hmm. As opposed to banks. I hate banks. I've never used bank financing to buy property, and I never relied on it to sell properties. And that helps you sleep at night. But it depends on your model. My model is buy with terms, sell with terms. And of course, terms mean price versus terms. So low ball price, all cash, right? We all do that. And then the highest price with the sweetest terms and everything in between. Any money you get a seller, an owner to carry back on whatever type of property, that's a potential profit center later. If you have your cash reserves, if you're doing well and they're not later, and they don't want to wait longer for their money, you can pay that debt at a discount, increase your wealth, get the highest guaranteed rate of return you can get on your cash. Okay. And also, I don't rely on the interest rates, again, because I'm not relying on buyers to get bank loans, and I'm not relying on getting loans to finance my properties. You can dictate the rates with a seller. So that's just like my safe space. That's where I've gravitated towards. So if you are relying on anything outside your control that you can't kind of manage, then reel that in and build some bigger cushions and bigger cash flows, bigger equity cushions, longer term, that type of.
Hey, can I ask a question? I know this is your show, Brian.
Joe, I'm going to ask you can you write that question
yes.
down so you don't forget about it? Because I want to take just a quick little 2 or 3 minute break. I want to introduce, first of all, we got a couple of new folks on the line as well. Jeff Watson, I'm going to have you introduce yourself here in a second when we come back to get Joe's question. Ken Joslin's on the line too. Ken, I appreciate you being here and I appreciate you wanting to contribute. I first want to bring in Eric Upchurch, who's down at the very bottom of the screen. And he's the mastermind behind this entire thing. The only reason we're even all here gathered tonight, everybody in here, is because of this man right here, Eric, former special ops. And he's the one who's organized this, the hike we're doing, the Lake Tahoe Trail the rim trail hike. It's 170 miles. We're raising $170,000, $1,000 per mile hiked. Eric, I want to give you a chance to really kind of dig in. I've kind of done a very average job of explaining what it is and why we're doing this and what exactly it is that people are contributing to tonight. But we're asking folks right now, I'm going to put the link in the chat again. Make sure you click on this link. If you're watching this, getting any value out of tonight, I'm asking you to donate, make a donation. And Eric, I want you to just take a few minutes, tell everybody why we're doing this and what this donation is for.
Yeah, hey, thanks, Brian, for doing this kind of last minute before our hike next week. Yeah, and Bratz, I saw you generously donated, so thank you for that. Every donation, if you're out there listening in social media world, will help save a veteran's life. There's 38,000 homeless veterans on the streets right now, every single night, and these are men and women, a lot of them with jobs. It's not the guys and gals you see all the time on the exit ramp that have drug and alcohol problems. It's families, and it's fathers and it's mothers, and they're in between housing sometimes. And Veterans Community Project is building permanent housing. They're not mobile structures. They're slab construction to code. They're beautiful 260 to 320 square foot tiny homes that are all different shapes and colors. They have interweaving sidewalks and fire pits, and really give veterans a sense of community and that they belong somewhere. Vets can live there for up to 2 years and 1 month, 2 years, 1 day. And the goal, and they're very successful getting veterans off the streets and into permanent housing. If a veteran is given 18 months of stable housing, their chances of staying in stable housing for the rest of their lives is 95%. So VCP has started in Kansas City. Nathan Brooks introduced me to VCP. I was speaking at one of his events in Kansas City, and so they've got 2 acres, 50 homes in Kansas City. Now they've broken ground in Longmont, Colorado, Tulsa, St. Louis, Oklahoma City, Sioux Falls, South Dakota, and they've got several more. There'll be 8 communities nationwide by the end of next year. They are a platinum rated nonprofit. Everyone gets a receipt, write offable for some people. And it really makes a big impact. Their ratio of what you give to what goes into the thing is above 85%. And the only reason it's that low, which is still really high, if anybody knows anything about 501c3 nonprofits, that's a high ratio. And the only reason it's so low is because they're building new construction, and the IRS considers construction as an operating expense. So unfortunately. So anyway, your donations are welcome. Your donations are helpful, and you will help save a veteran's life. So in December, when I just kind of thought of doing this, I said, 12 real estate investors? 12 is the maximum you can hike with around Lake Tahoe, by the way. That's why 12. So I said, I'm going to put together an application. We're going to get 12 rockstar real estate investors or entrepreneurs, and we're going to raise $1,000 per mile and crush it for Veterans Community Project. This is the tip of the iceberg. I plan to raise millions over the years to come. The first $500 million I run across will end veteran homelessness permanently in the U.S. So that's my target. 500 million will do it. Thanks, guys. Appreciate it. Hope I didn't talk too long there, Brian.
Awesome. No, you didn't at all. Eric, I'm so grateful for you, and grateful for you putting this thing together. And Nathan, who's also coming along this hike, Ed, who's up here, is also coming along. We're so grateful for all you guys. And I'm just honored just to be a small little kind of cog in this wheel. And for everybody, all the panelists who are on here, and everybody who's joining us, watching on YouTube or watching here, we appreciate you guys so much. And if you can donate, do it. We really do appreciate that. So with all that being said, Joe, McCall, hopefully you wrote your question down.
Yeah. I saw, where'd he go? Jeff Watson here. And I'd be curious to know and Richard Roop, of course, you've been in the business a long time, very familiar with creative financing. Now that interest rates are going up, almost 6% now, and there's a lot more investors doing creative types of real estate like subject twos. Do you see banks maybe, because banks know we're doing subject twos, right? They know we're doing lease options and stuff like that. Do you think banks are going to start having an interest in starting to call some of them due more frequently because they know they can get that house back? They can take that money out and get a higher interest rate somewhere else. Or are they just going to be, yeah, we're getting the payments, we don't care? Does that make sense?
Jeff, I'd love to hear from you. First, introduce yourself and then answer, if you don't mind answering the question.
You want the short intro or you want the long intro?
We want the short intro for sure.
Let's do short. My name is Jeff Watts. I'm a lawyer licensed in the state of Ohio. I represent multiple clients, and any view or opinion I express tonight is solely that of my own and not of any of my clients, including but not limited to National REIA, Note School, Real Flow, whatever. So please, it's all on me, not on them. All right. So Joe, the answer to your question is no, I don't think banks are going to do it. Reason why is there's been a huge divorce between the servicing industry and the lending industry. The servicers crave those consistent, regular monthly payments. They like that large stream of vanilla that is auto ripped out of checking accounts across America that processes through and boom. They don't want to rock that boat. That's the only place they make money. On all the specialty stuff, that's where they're losing money. And that's not my opinion. I've happened to have a chance to just one night pick the brain of a guy way, way, way up in the servicing department at one of the biggest banks in America. And that's what he told me. So, Joe, it's a fantastic question, but the answer I think should make a lot of people relax because of the separation between servicing and actually lending. I don't think we've got much to worry about. Now, let me flip it around. Folks, if you're going to go out there and do a sub-2 deal, and then you're going to get the bright idea to default on those payments to try and negotiate a short sale, do us all a favor. Walk down to the local FBI office, stick out your hands, ask to be cuffed, and ask for your size in orange. Because you are a freaking bum. And we might as well just escort you right on out to begin with. If you're going to take something over with sub-2, you do everything in your power, including skipping meals, to make sure that those underlying bills are paid, those underlying mortgages are paid. And there's a couple of jokers out there. I'm not going to name any names, but there's a couple of jokers out there that have made a mess in some states in the South. And I don't want to see a repeat of that. Okay. All right. Have I said anything controversial yet, Brian?
All right. So Jeff, send me those names. My buddy, as far as the banks calling loans due, the last time they did that, they had a reason to do it, was when interest rates were like at 18%, and they were sending people down to the courthouse to see if the borrower's on title so they could actually call the loan, right? Type of thing. So if interest rates go crazy high like that again, they might have an incentive, but after all these years, all this concerns about due on sale clause, it's not an issue. Just make the payments. They want the payments and make them on time. And if you commit to them taking over people's payments, like he said, you don't eat until you make those payments. So, or you if you get in trouble, call the seller, work it out, give the house back, do something, but don't let it go.
I think this is an important discussion, and someone else has already talked about it. Like I'm telling everybody, if you want to be successful in this market, you have to understand creative financing. On the commercial side, apartments, multifamilies, and single families, you got to know how to structure multiple options to sellers because, man, I don't know if we're ever going to see 2.5%, 3% interest rates again. And how amazing could it be if you could take over a loan with 25 years left on it, 20 years left on it at 2.5%? Like,
well, that's what we're doing now.
Yeah,
that's what you guys,
phenomenal.
If you want to do subject twos, go out and get those loans. Those are great loans.
And they're going to be easier. These kind of creative financing deals are going to become easier and easier to do as the market shifts and becomes more of a buyer's market.
Guys, Ken, I wanted to give you a chance to introduce yourself real briefly and tell everybody who you are, what you do, and love to get your take as well on where you're seeing I know you're a realtor and you do a lot of stuff, but you are a realtor and you're involved in the real estate space. Where do you see the market headed?
Yeah, so I was a top mortgage broker, Georgia, Florida, Alabama from 01 to 09 when the market crashed. Obviously, this is different. It was funny back then, they blamed it on subprime loans. It had zero to do with subprime. It had everything to do with my community and all the Fannie Mae deals. We were doing 100% loans to people who could fog a mirror up, who you didn't have to source or seize any kind of money. Now it's different. My main question is if you're working with buyers, it's very difficult because you're getting, 12 showings a day, multiple offers. We've got a ton under contract in the Atlanta area and in Birmingham right now. My question is how much higher can house prices go on that side? I know it's a little bit different. You guys are all multifamily. Tim, I haven't met you, but my guy, Andy Sally, just texted me and said to tell you, hey, I sent him a screenshot. I said, some of these guys right here. And he said to tell you hello. So I think for me on my side, guys, I don't do a ton of multifamily. I run a large mastermind with 8 and 7-figure earners. And a lot of those guys are multifamily investors. So for me on the other side, just for the residential side, I wonder how much higher residential prices can go until we've priced people out of being able to afford homes. One of the things that is really cool, I actually moved. I just went through a divorce a while back. I actually moved into a whole subdivision here in Birmingham. And I don't even know if you know this yet or not, but it's single family resident homes and it's all rentals. They're 3, 2.5, super nice. And it's a whole subdivision, clubhouse, pool, everything. And it's all rentals. So I know that there's a lot of money going into that market. So for me, it's more going to be on the residential side. Is how much higher can residential prices go on homes? I know with the rates going up again, I was a mortgage broker forever. With the rates going up the way that they're going up right now, that's going to slow some of that down. But how much higher can residential prices go before we see that turn and start to dip?
I wouldn't rely on it going up any further from today. I mean,
I don't know that it can, because we're seeing prices in the Atlanta area, they're going up 26-30% a year.
I'm gonna step in on this, Brian, for just a quick second, okay? And because my time's limited tonight.
Jeff.
Guys, if you're paying attention to this, and if you think you're going to see 2008 all over again, I'm sorry, you're wrong.
Mm-hmm.
This is not going to be 2008 all over again. We got to go all the way back to 1973 through 1982 to see a similar but not identical environment. And let me go back to Ken's excellent question. We do not yet have begun to process what $6 a gallon diesel fuel is going to do to our economy, what it's going to do to grocery prices. We haven't begun to process what $6 and $5 a gallon gasoline is going to do in the Midwest to consumers driving to and from their jobs. So when we see utility costs going up, gasoline, diesel fuel going up, food costs going up, insurance going up, real estate taxes going up, it is going to tap out the American consumer. They're done. They can't afford anything more. They're going to move back down from their luxury A+ apartment down, like Tim said, to their B+ apartment. That's going to start to happen. But it all comes down to what can people afford to pay. And if you live through, and I think Richard, you did, and I know I did, if you lived through the 70s into the 80s, you got a clue of what we're looking at. But we're different this time because of the massive amount of debt that's out there. When we went through this crisis, the federal government didn't even have $1 trillion of debt on the books back in 1973. We didn't punch through $1 trillion until Ronald Reagan was office about 1982, 1981. We are now rapidly approaching $28 trillion. The debt service on that alone, interest only cost, is something that is going to be the tail wagging this economy going forward, because interest rates can't go up that much more. Or otherwise the federal government can't afford its own bond service. It can't afford its own service on T-bills and savings bonds, et cetera. Okay. So we're going to be in a lower interest rate than we think it's going to go. We're not going to see what we saw with Volcker in the early 80s, which means inflation is here to stay. Mm-hmm. And we've got to adjust to that. And I'm going to tell you right now, I don't care if you're multifamily, single family, mom and pop rental, whatever you are, the number one thing I scream at you to do right now is enhance your management skills. Enhance your management skills. Get better at attracting and keeping good quality tenants. Get better at managing your costs, because that may make the difference of whether you survive or not. when your tenants start doubling up on you. When all the folks that have got 1 or 2 people in a 2-bedroom apartment, suddenly it's going to be 5 people in a 2-bedroom apartment because they can't afford it any other way. We're in for an ugly shit show. Pardon my language, but we're in for an ugly shit show. We need it. We're in for it. It's coming. Fasten your seatbelts. If you know what you're doing, if you can find creative deals, if you can structure creative deals, and if you can manage those properties well, you're going to be fine. Other than that, I don't know.
Thank you, Jeff. I appreciate that. Anybody with a response? Anyone with a dissenting opinion?
So, yeah, my opinion really isn't like dissenting totally. I mean, I agree with a lot of the stuff Jeff said, but
I'm trying to stir things up, Jeff.
Yeah, stir it up, stir the pot. So,
stir the pot, man. I want to hear somebody tell me I'm wrong.
Yeah. Well, what happens in this environment is inflation just destroys the standard of living for people, which Jeff, to his point, he alluded to that completely. But what's interesting about it is the powers that be, whether it be the government, the Federal Reserve, they somehow think the economy is doing well if asset prices are going up through the roof. But consumer inflation is relatively tame, right? So they try to, like asset prices going up, that's great when the stock market's going up, when housing's going up, that's all great news with the powers that be. But consumer price inflation, oh, no, we can't have that, right? Yet, Biden has done everything to cause that, which is unfortunate and very sad. But, I'll just share my screen for a second and show you something that's kind of interesting. And I don't know where this will take the conversation. But, for my Hartman comparison index, we did an analysis of housing payments. And back in 1970, 52 years ago, the mortgage payment on the median price house was $127. Today, adjusted for inflation, it's $195. Now, granted, this is at 4.68. Rates got a little higher than that since the last time we did this, so we got a little bit of an adjustment. But this is the payment today, $1,477 on that median price house. $195 if you believe the government's lie called the Consumer Price Index, right? And so I'll get to that one in a minute. And so this is that mortgage payment over the years, right? Adjusted for CPI inflation, which is manipulated low through weighting, substitution, and hedonic indexing, right? They want to lie to us about the CPI because it's beneficial to the government. But here's what's interesting. If you look at the way they used to figure the consumer price index before the high inflation of the late 70s, early 80s took effect, and Volcker came in and fixed that problem by breaking the back of inflation with mega high interest rates that, to Jeff's point, the government cannot afford because there's no way they could pay the debt. Like, they can't pay the debt now. And imagine if they had to service that debt at 15% or something like that, it'd be absolutely impossible. So that is a statement for low interest rates in some reasonable range to continue into the future. But go to shadowstats.com. I had the founder on my show, John Williams, and he simply says, well, what if we just use the old method of figuring inflation before they really started to manipulate it like crazy in about 1980? And so here's the CPI inflation adjustments, but watch this. Add shadow stats inflation adjustments, and you see that the mortgage payment in 52 years is now half of what it was 52 years ago. So housing really is not as expensive as people think. They think it's expensive because they only compare it to one thing, the US dollar. And if you look at it that way, well, hey, Sonny, 52 years ago, my mortgage payment was $127. Now it's $1,500. Yeah, but the dollar is worth a lot less than it used to be. So you have to do the inflation adjustment, right? And so CPI inflation says it's 195, which is a little bit higher than it was in 1972. And you can look at it any time period you want. But here, shadow stats, it's only $58. Okay. So, that's the funny thing, right? Like, the standard of living in so many ways is so much better than it was years ago. but we kind of forget that in a lot of ways. You know, we just sort of forget that our houses are so much nicer. They're so much more energy efficient. You know, we've got quartz countertops and nice flooring, when we used to have like shitty green shag carpet and avocado green formica and crappy old appliances, right? Like, these houses are a lot better than they used to be. Now, one thing and they have more square footage than they used to have. But one thing that's really misleading about it, and I'm sort of arguing against myself now, is that the housing is much higher density now. So no one considers that. When you look at all these studies saying, the typical baby boomer house post World War II was like 900 to 1,200 square feet in Lakewood, California, for example, or Levittown, right? But now it's 2,200 square feet. But it used to be a quarter acre or a half acre lot, and now it's a postage stamp or, a townhome, right? So that's misleading as well. But this is just kind of really interesting when you look at it. Those mortgage payments, even at the higher interest rates, aren't that high. Jeff?
So,
thoughts?
Jason, what do you mean by that? Interpret that like, so what?
Well, the so what is that in relative dollars, in constant dollars, adjusted for inflation, because everybody's salary has gone up, they're making more money, right? The dollar is just a moving target, right? This is the mortgage payment today. It's either 127 back then, 639 in 1980 when housing was super unaffordable, or whatever period you want to pick. And here's the number today with the government's number of inflation. And here's the more realistic number with shadow stats, figuring inflation the old way the government used to figure it.
So,
Okay,
Jason,
so how would that?
what Joe's asking is, what does that mean? And I think what you're saying is, it makes sense to borrow money even though interest rates are higher. Is that what you're saying?
Oh, for sure. Yeah, like we talked about earlier. And I'll just give you the visual on that because it really just illustrates it so well. So yeah, so everybody's complaining about the high rates, right? So compared to what? Here's the CPI inflation. You're getting paid 2.5% to borrow. With real inflation, if we call it 15%, you're getting paid 11.7% to borrow. And that's if you don't rent the house. If it's a rental property and you rent it out, you're not even paying the debt. The tenant is. It's like the most awesome deal ever. That's why I love income property. It's just
Jason, somebody's going to say maybe, but yeah, the mortgage payments as a percentage of an average income is higher than it's ever been.
That's true,
Is that true?
Because, well, I don't know that for sure, but it feels true, right? That anecdotally feels true. And so I agree with you, anecdotally at least. But I remember when my mom bought her first house, she was freaking out when I was 11 years old because her mortgage payment was $416 a month for a house in West Los Angeles that she recently sold. It became a rental property for many years, and she recently 1031'd it and sold it for $1.6 million, right? And that payment felt lighter and lighter and lighter over the years as inflation just debased the debt. And that's the beautiful thing about real estate, owner occupied or income property, but obviously it's better if it's income property because you're not paying the mortgage. So I don't know, it's sort of like there's these cross currents, right? And it's complicated.
It's who is it affecting? Is it affecting sellers, buyers, investors? And so I think if you think about what would happen, because this is going to happen, if everybody want to know what's going to happen, here's what's going to happen.
What's going to happen? I thought Jeff told us what was going to happen.
Interest rates will go up, will continue to trend up, and incomes will go down.
Yeah. In real terms, real dollar terms, at least.
In real dollar terms, and people will feel the pinch. So you need to help, as investors, as professionals, we need to help those sellers. We need to help those buyers. We need to create programs so people can have nice housing, affordable housing. And if you're going to pick a market, pick an affordable market. If you want to avoid a market, avoid the bubble-ish markets. The ones I looked at a property the other day, $700,000 house for this, $700,000 for this little 2,400 square foot house. It just didn't make sense to, that was the value, but that was the market value. So we can still pay 700, but when am I going to give them 700? 30 years from now? So, but I would avoid, if you've seen the prices go up, and Jason, yeah, we talked about this, I think yesterday. If you've seen a lot of appreciation in your dense metro areas, those are the ones that are going to get hit with a market change the most. The higher priced homes, the more dense homes, the ones that have gone up crazy.
Here's a shortcut way to look at that. What you're saying is absolutely right. Cyclical markets are the trophy markets, right? The West Coast of the US, the expensive Northeastern markets, South Florida, where I live, right? Those markets, any market that has high land value is riskier, because the high land value, that's where the cut comes from. And in the upside, that's where the appreciation goes. It goes to the land value. So you want to buy cheap land value and high improvement value as a ratio, right? So these little rental properties that we all like, those are the best thing. And so for investment, inexpensive entry-level rental properties are great. There's a huge shortage of them. We all know that. But that's for investors. But for society, what needs to happen, because it's really sad to see this concentration of wealth, and look, we're all part of the wealthy class, okay? And so good for us, but it sucks for society, because a big middle class makes a stable country, and we're losing that. We've been losing it for decades, and it's really bad for society. So what has to happen is the government needs to get the fuck out of the way and allow people to build more houses. That's what needs to happen. All of these land use restrictions and all of these codes that, I live in South Florida, and my house is a tank. It's probably bulletproof. I don't know. This house, I don't think any hurricane could blow this thing down. It's ridiculous. But, maybe we could just build some more basic houses that don't have impact glass, that don't have, steep walls made of steel, and people could live in them, right? Instead, they're causing a homelessness problem and putting people into their cars and on cardboard boxes on the street, right? So maybe not every house needs to have, fire suppression systems. We live for hundreds and thousands of years without all this stuff. I agree it's nice. Someone's going to yell at me and say, oh my God, you don't care about people. No, I do care about people. I don't want them living in their car, right? So maybe we could build some less expensive houses. That would be really nice.
Guys, listen, we're going to take some questions here in a second. I just want to acknowledge the fact that we're over $130,000 raised so far. And I'm just completely blown away and grateful to everyone who's on the call and everyone who's donated. Ken, who just jumped off. Ken, thank you so much for your donation. Tim Bratz, Joe Evangelisti, which Joey, we haven't even talked to you yet. I'm about to get you on here in a second. Gabe, Mark, Evans, we appreciate you guys so much for donating, and for not just your dollars, but donating your time and your knowledge as well. So super grateful to you guys. We're going to get to some questions here in just a second, but Joe Evangelisti, we haven't heard a word. We haven't heard a peep out of you. You're sitting there just taking it all in, man. I'd love to kind of get your perspective on what you've been hearing from tonight.
You always got to watch out for the quiet ones.
I'm telling you, Brian, first of all, I can't even believe I'm on this panel right now. I'm humbled. These guys are like some of my idols, my mentors. So it's awesome to be on here. Jason Hartman, I have no idea how I don't know you, but I need to. We're going to talk after this.
Sounds good.
Let's talk about homeless veterans for a second. Okay, Brian, I think me and you really met and connected years ago talking about a different charity you were running for vets. You guys know that I do a lot for vets. I am a vet. And, guys, there's over 49,000 estimated homeless vets in this country. So, any state that you live in the union, think about this. There's probably 1,000 people who have really, literally volunteered their lives for your freedom that are sleeping under a bridge right now. So pick out your credit card, go on that link, and donate some money. That's what we're all here for. So I want to see you guys raise this 170. One of the things I think that's, not been talked about so far, Brian, if I can add any value at all, because there's so much freaking value that was added tonight, is the real estate, the most valuable real estate on earth, right? And that's this real estate, right? Between our two ears, right? How we control ourselves, how we control our emotions, how we control, what we can control, right? Because we can only control what we can control. Interest rates will go up, interest rates will come back down. It'll be more difficult to buy properties. It'll be easier to buy property. It's what we do as an entrepreneurs And everybody on this call is supposedly an entrepreneur or a, you know, a wannabe entrepreneur, right? And that is, we solve problems. You know, our job is to solve problems. Our job is to get out there in the industry that we're in, whether it's single or storage or multifamily or whatever we're doing, you know, pharmaceuticals, it's to figure out how to make money. And when the economy goes up and down, a mentor of this, you know, told me years ago, this I think is over here, if you guys, if we're all in the right spot, Mark Evans, right? The money doesn't disappear. The economy disappears. The stock market plummets 30%, trillions of dollars go away. They don't go away, they shift hands, right? The money is somewhere. Our job is to control our ability to do our job in a down market. And the smart people will take advantage of a down market. The smart people will figure out that there's less competition. It's not as fun as it used to be a year ago. It's more difficult. And those of us that are willing to put in the work and solve the problems and figure shit out are going to win in the long run. So if I can add anything, I think that's one of the things. You know, I'm not an economist. I'm certainly not as smart as Jason as far as the market trends and, you know, Jeff talking about, you know, economic downturns from 40 years ago before I was born. But the idea is, like, let's figure out how to solve problems, guys. Let's figure out how to go out there and create, you know, there's abundance of ability for us to all succeed. There's no economy that's going to change that. Short of a major world war, right? We're all going to go out there and we're going to win. So that's your job. Your job as an entrepreneur is to go win.
Yeah. Awesome. Well said. You guys ready to get some questions? Yeah, go ahead, Gabe.
I posted this in the chat real fast. Jason, I think you would like this, but check this out on page 17. This is a chart from HUD.
Do you want to share?
Can you share your screen?
Yeah.
Yeah. So it doesn't go back to 1970. So I couldn't find anything from 1970, but 1985, a ratio of housing costs to monthly household income hasn't really changed much.
Yeah. Yeah, that's interesting.
It really hasn't changed much at all. Now, I don't know from 1970, you know, how much it's changed, but, you know, it kind of goes to show you, to your point, that it's really not costing us that much more.
Yeah, but here's the thing, though, and Jeff alluded to it. And thank you for sharing that. That's true. I mean, I think it's very true. Housing is not that expensive, but you know what? Everything else is. And that's kind of the thing Jeff was alluding to. So the consumer is just, I mean, think of all the inflation we don't notice, all the stuff we have to do ourselves nowadays that we used to have people helping us with, right? And so there's a lot of other burdens on that consumer, and the cost of food and healthcare, and obviously college is a complete ripoff now. You know, so that part of the equation, it doesn't account for their, you know, 1/3 of their income that goes to their house, but the other stuff's gotten a lot more expensive in many ways. I mean, not technology, right? This phone is awesome and it's way better and it's cheaper, and, you know, a lot of that convenience is there, but healthcare, food, you know, stuff that's kind of low tech, and diesel at $6 a gallon, and the cost of trucking, that's going to be a problem. I agree.
That's why the government doesn't want you to eat a steak, and they want you to eat a soy burger.
Yeah, exactly. Well, Bill Gates wants us to eat bugs. Look at my Instagram. I posted a meme about that yesterday.
Mark, I want to bring you back in here and ask you a couple questions. Obviously you're in real estate, but you're in so many different sectors. You got your hands and toes dipped into a lot of different things. Where do you see the opportunity right now? Is it different than what it was 3 to 6 months ago? Are you kind of in your mind maybe gravitating towards something else right now? Do you see a specific opportunity and a gap in the marketplace?
You know, I think the thing is, again, it's the data, not drama. I'm focused on my data too. You know, a lot of people are looking at all this amazing data. I have zero clue what it says. You know, like, this is like someone saying asparagus is amazing for you, but it's asparagus.com telling you that, right? So it's like, how do you decipher all this data? I am not smart at all, but I know what my numbers say. Because I always say mind your own effing numbers, because our numbers are so important to us as a unit, knowing what strategy we're in, what our investment thresholds are, what our real play is, what our lifestyle looks. I mean, there's so many internal variables. And if I start looking at some of the stuff all you guys are showing, it's amazing, but I have no clue what it means. You know, I remember in 2008, I made a lot of money. I made more money in 2007 to 9 than I did in my first 12 years of business. just because I was in the game. I think this is the game where, my biggest fear is we're sharing a lot of amazing stuff. It's going to put a lot of people on the sidelines and scare the shit out of them. If you're in the game and you're paying attention, you have your head on a swivel, you kind of feel the rhythm. You can kind of go with the flow, buy right, kind of everything Tim and everyone's saying. Buy right, don't speculate, have good term. I mean, just be aware of what's going on in the marketplace. I do think a lot of people are going to be scared and not do anything as an investor, because they're like, oh my gosh, what if I mess up? Well, you're going to mess up. But question is, just don't make it catastrophic, right? So I'm involved in a bunch of, I love all types of cash. I love cash flow businesses, period. Cash flow real estate, cash flow businesses. Ideally, they're recession proof or as recession proof as possible. That's why I like the pet industry and things of that data, pet, and real estate. But listen, I think what's cool about it is we're like in history. There's going to be a data point on someone else's thing about 20 years from now, and we're the case study. So I think it's a really neat thing. And there's a lot of weird money out there. There's more money than we've ever seen, but like the watch market, the car market, everything's changing. That market's already shifting. It's down about 30% already. So the high end in the last 6-8 weeks. I mean, so I think it's just get in the game, get around great guys like this and gals, and, really connect, find someone, find someone and stick with them. If it's Jason, Jeff, Joe, Richard, Nathan, all these great guys here, like pick that strategy and learn it and just become an expert. Don't try to be an expert at 27 different things,
Yeah.
No, Mark, you said you said that some people might be sitting on the sidelines with some fear and with lack of confidence. I would say anybody feeling like that should realize that that's what everybody else is doing.
Yeah.
You should get off your ass,
Yes.
find out how to take advantage of what I call the perfect storm. It's unfortunate for folks, but it's the perfect storm.
Really?
So this is a huge opportunity.
Yeah.
So get excited, get some help, get educated, and get into action, helping people.
And use Richard's postcards. No, I mean, listen, I think if you're a great marketer right now and you understand what's really going on, you could make a lot of money, right? Because you could really talk to like marketing is all about touching the emotions extract, right? So you could really touch on people's fear buttons today for extraction and conversation to really help them, to help you. I mean, everyone could really win if it's done properly.
Yeah,
for sure.
I was underage and unable to contract in the 1970s. I hadn't turned age majority yet, but my earliest mentor during that time frame that I described, 73 to 82, made millions. And he never got past high school. So if you think you need an education to make money in real estate, I'm sorry, you're wrong. He made millions from 73 to 82. Yeah. And that's when I figured out that that's where money's made, is in real estate. And if we watch, we all know people who made a lot of money in the last 10, 12 years in real estate. We know a lot of people like you, Mark, that 2008 to 2010 was prime season for y'all. So do not be scared. Just know what you're going to do and go do it.
Yep. That's awesome. I think there's a lot of opportunity for everyone here as well to educate people that have access to capital. I was sitting at a table today with a guy who has $30 million of cash. He's a professional athlete, literally sitting in his bank account. He's scared. He's very scared. He's like, dude, he's afraid of all the sharks coming after him. They want his money. He's like, I need to put it somewhere safe where I can get 3%. He's only wants 3% a year net, right? And because he's that scared. Yeah, but like the thing is, he's so afraid he's not going to move it, even if you give him 4%, right? So he's just got his nerves. He's got a lot going on. He's got a big bone, like a lot of stuff going on. And as this stuff's going on, I think our job as leaders, because we're all solution driven, is help other people by giving them guidance, confidence, show them the path. There's a lot of opportunity here on both sides, sellers and buyers and investors even, right? Because we can really, I know Jason does a lot of education and everyone here is educating, but if we can educate the real money guys at the next level, because I think too, a lot of people don't even trust the banks at another level right now, right? They don't want to put their money in the bank. That's why crypto is crypto. But if they can get into some solid assets and, just show them what Jason was showing, kind of like, hey, and, borrow at this number, do this, you're going to be plus XYZ. Like, this is a great way to hedge inflation and grow and make a lot of money. Like, I think we just educate and create confidence through education.
And Mark, that guy is, if he puts his money in the bank, he's surely going to lose 12% a year. That's a sure loser.
But the thing is, he's so scared. He's okay with the loss of he'd rather have a guaranteed loss than an unsure win.
Right.
So he's so like, because the problem is he's inputting so much data.
Yeah.
You know, he's talking to way too many people. We've all been there, right? You talk to too many people, and this guy going on WebMD, right? You think you got a cough, and all of a sudden you're dying tomorrow, kind of thing. You know, he's just over informed now, and it's actually creating massive scary.
Yeah.
Let's get to some questions. While we still got a few of you on, we're going to go for maybe 20 or 30 more minutes, guys. Let's get to some questions. We still have a good following on YouTube, and I want to kind of dial all the way back through here because there's been some really good stuff. What market do you think would be the best to invest in right now? Residential, multifamily, or commercial? Anybody having? I think that's more of a niche thing. I think that's what, if you're best at this, you should go after whatever you're doing, whatever you're best at. Does anyone have a strong opinion on that question?
Well, this call is going to be biased to what they do, right? I mean,
yeah. I
Well,
think
Warren,
industrial is the best, but I'm sticking with the multifamily.
Yeah.
If you're starting, start at what you know best. Pick a lane that you're the most comfortable in and stay in that lane and run.
Put the blinders on.
Yeah, it really depends on your investing model and your location. I think a lot of people, if you get good at marketing, you can buy all the deals you want locally, depending on your model. So stay in locally, being a big fish in a small pond, and a high level strategy based on what we talked about tonight is it doesn't matter what the price of the property is. It doesn't matter what type of property it is. It's the cash flow. It's the income. It's the revenue. That's the value of owning income producing assets that go up in value over time, that appreciate and all the benefits of, depreciation and all that. But cash flow is super important. And that's how you should evaluate a deal. That's how I do it.
Well, let me ask you guys this, because this was another one of the questions. I'm going to kind of frame it how I want to frame it, but being creative, and whether it's sub 2, which I'm not even really that big of a fan of sub 2, but option contracts, option deals, just being owner finance, seller financing. What do you guys, is this going to be more prevalent? Do you feel like as real estate investors, and I agree with what you just said, Richard, staying hyper local, you know the market super, super, super well because you're there, and you can put your finger on the pulse of it. But I feel like creative deals in some way is going to end up being the way to go. Does anyone have a strong opinion
solution?
about that?
Yeah, it was. I created the ultimate strategy in 2008 because that was the solution to what was going on with and taking advantage of the opportunities. Actually, I created in 2007. By the way, any of you, in fact, anybody who wants a copy of that $1,500 course from 2007, I got it online. I'll give it away. Just get a hold of me and say that you donated tonight. All right, to the vets. Okay, and I'll send you a $1,500. Donate $5 or 50 or 500 or 5,000. I'll send you that. And if you don't know how to get a hold of me, get a hold of Brian and I'll get that.
And if you guys, Richard, feel free to put your Instagram or Facebook or whatever it is in the chat. And all of you, I want to encourage all of you to do that. You should, if you're watching this in YouTube, wherever it is, guys, you need to be following everyone who's been on the panel. They're on the panel for a reason. I personally hand-picked them and hand-invited them and asked them to come do this. So you should be following all of them. But getting back to the question.
Yeah, the owner financing absolutely is always helps solve a lot of problems all the time. I mean, it always works. Creative financing, owner financing. So was that your question, Brian?
Yeah. Jason, what do you think about you're more, correct me if I'm wrong, but you kind of deal more with the retail buyer who's buying a turnkey property. That's kind of your bread and butter.
Yeah, we do more turnkey stuff, but I'm in favor of creative financing. I think it's great if you can do it. Just the only thing I'd say is, don't sacrifice the property quality for the financing. There's that old saying, you can have price or terms, but not both, right? But as we all know, if you're good, you can get both. Okay. And I know Richard gets both all the time. But just don't make the property, don't get a bad property just because you've got good financing, right? That's all I'm saying. You got to have a balance between all of this. The creative financing stuff is, it's awesome. I know how to do it. I bought my first property with nothing down when I was 20 years old. And I think it's great. It requires a little more work and a little more creativity, but you can.
And it's a smaller number.
Yeah.
You have to find the people that are.
Yeah, you're going to narrow your market down. Yeah, no question. Yeah.
Jason, and then Nathan, this is kind of a question for you. Anyone who's doing kind of more turnkey stuff, what about the turnkey buyer? The buyer that's out there who has been buying these investment properties retail. They're paying retail for investment property, single family. Where do you see that market, that turnkey market going here in the next 6 months, 12 months?
I think it's going to continue. I think we're a year or two away from a serious market correction. I don't think it's coming soon. And I say that just because inventory is way too low to have a crash.
Jason, let me interrupt you for just 1 second.
Low inventory.
I think what I'm asking you specifically though is, correct me if I'm wrong, but I feel like the retail investor, the retail buyer, the one who's buying the turnkey real estate, that person may feel this fear. They may feel like something is happening. I'm asking specifically what is going to happen in the turnkey market that is so reliant on that very specific buyer who is buying these properties at retail that most of us can get wholesale. And they're buying them at retail at pretty steep prices.
Are you saying they're going to stop buying, or the ones
I'm
that
asking,
already own are going to sell?
Do you think they're going to stop? Do you think they're going to stop buying? Do you think that the turnkey market's going to dry up a little bit?
No, not yet. I think
Jason,
the demand is overwhelming still, even with the higher rates.
Nathan, I'd love to hear what you're seeing.
I was just at IMN as well in the single family conference, and every single one of those hedge fund buyers, institutional buyers was talking about, the additional number of units they were taking down. And I truly believe that any units that our individual turnkey client buyer wouldn't buy, those guys are buying as long as it fits in those buy boxes. And we were even seeing that they were, those buy boxes for those buyers were widening. They were looking for other markets. They were looking for guys, like us, who could even build 40 homes in a development where, a year ago we were hearing they wanted 100 plus. So, for the level of demand that those guys had, and as well as, any of the turnkey buyers who are looking in those middle markets. Got a good buddy of mine who's a builder and flipper in St. Pete. They have 100 plus, waiting list on theirs still. Every single house that comes in, they're selling it. Friends in Dayton market, same thing. Des Moines, same thing. So we haven't seen a bit of a slowdown from either side, other than when those cash flows are adjusted on the little, higher price with the turnkey, individual buyer. If but a lot of those people are just being told, hey, if you put 5 or 10% more down, and they're still buying them.
I mean, I think, to dovetail on what Nathan said, the demand is still incredibly strong for these entry-level houses. Yes, the buyers feel like, oh gosh, a few months ago I could have got a lower interest rate. Of course, it could have, should have, would have. Everybody says that. But the real question is, when someone has some capital and they've got to get a return on investment, it's always a question of compared to what? What is the least worst option? And, single family homes are not a worst option. They're great, right? But what else are you going to do? I mean, are you going to put your money in the bank? Are you going to put it in the stock market that's crashing? You're going to put it in crypto that's crashed? What other option do you have? It's only a question of what options are available. It's not a question of, don't we wish it were better and rates were lower and prices were lower? Of course we do. But, we look around today and we think, what are the choices? And then we pick one. We pick the best available choice. That's all we can do.
Yeah, that makes sense. Makes sense. I'm going to start scrolling through here for some more questions. Jeff, you said you had to go earlier. I'm glad you're still here. Do you have any other insight for us as we as it seems to be we're in some tumultuous times here, some people would say. Any insight for the folks who are listening in?
I'm going to dovetail off of something that Jason said, because I thought it was very profound. It even opened my eyes. That's why I'm hanging around. I've been telling a couple other people, bro, I'm running late, because this is y'all. I'm learning. I'm listening and I'm learning here. So this is cool. The cost of housing with shadow stats, that's interesting, because shadow stats is where you're going to go get the real numbers on what really CPI is.
Yeah.
But we've got a couple of twists that Jason alluded to it, I alluded to it, and I want to just come back and make sure everybody grasps it. The consumer has got bigger costs than they've ever had in some areas that they didn't have in the past.
Right.
So your cost of housing and your interest rates, that's not the problem. It's the real estate taxes. It's the insurance on it. Those are factors. It's the student loans that your millennials are still chewing their way through. It's the ever increasing cost of automobiles that they're financing, that they're chewing their way through. These are the things that, in addition to rising utility costs, rising food costs, and so on, that are just getting your consumers to where they're finding their limit. They're finding their limit, and it's going to affect us. The last thing I'm going to throw at you is, you do realize baby boomers are retiring. Baby boom generation, the demographics of the baby boom just completely reshaped the American economy from 1946 till now.
Yep.
Well, the baby boomers are doing it again, as 10,000 or so a day, that's the statistic, everybody loves to quote, are retiring.
Yeah.
We're going from creating value, because I'm a boomer, we're going from creating value to now we're going to live off of our savings and our retirement income.
Right.
And we're going to be a little more conservative with how our money's managed. We're going to be a little more cautious about what we're investing in. And that's an impact that we've got to process. And then the last thing I'm going to throw at you is, America is by far the best place to live. It is the best place to own real estate. And if you don't understand that, you need to figure it out from a demographics and topography and agricultural standpoint. Because if you're not in the United States of America, and if you don't border the United States like Canada and Mexico do, I'm sorry, the next 10 years are going to really suck for you.
Yeah.
Buy real estate in America and hold on, baby. That's the way to get through this thing.
Yeah, Jeff, you're really making the case, because I mean, the U.S. has always been considered the Brinks truck of the world, right? This is the place. There's so much foreign direct investment in the U.S. The FDI is off the charts in this country because we have good rule of law. Even now, I know we all complain about the election was a joke, et cetera, et cetera. But, we overall, compared to what, right? What other country beats the US, or at least major country? Yeah, Denmark. I've heard all that bullshit. I've been to Denmark a million times. Okay. It's not that great. And so the US is the hands down winner. I mean, it's going to maintain its reserve currency status. That means every other country is going to experience more inflation than we are. We obviously are going to have our share, but we have the reserve currency, so we can control it in ways they can't. And we've got this very special real estate market that has transparent data like other countries don't have. We have an MLS system like other countries don't have. And we have Fannie Mae and Freddie Mac like other countries don't have. So we have 30-year fixed rate mortgages that they don't have. Like, it's light years ahead of, and I was born in Europe, and I'm saying all this stuff, and I've been to 87 countries, and I've looked at real estate in about 35 of those countries seriously to think about promoting it to our investors. I just can't find anything that comes close to the US. So it's a way better deal. Yeah, the standard of living probably for the globe, other than people rising out of poverty into the middle class, they're moving up. But largely, a lot of people are, the middle class, at least in America, are probably moving down. And that's a sad commentary. It really is. But it is what it is. It's still better than anything else.
Jason, let me ask you an opinion. My feeling, I haven't looked into it, this is what I kind of feel, is that home value appreciation has been pushed up by the baby boomer generation. Now that they're being more conservative and retiring,
Yep.
we're not going to have as much fuel behind traditional appreciation in housing.
Right. Yeah, that's a good point. And that's what Jeff brought up initially. And Harry Dent started predicting that stuff back in 1995, and it made him very famous. And for a long time, he was right. He said that the baby boomer housing market of the McMansions is going to crash around 2010 to 2013, as would the stock market, as they pulled their money out and retired and got more conservative and everything Jeff was talking about. Of course, that was maybe delayed 12 years. Maybe it's coming now. But here's the thing nobody's talking about is that in 15 years, a lot of those baby boomers are going to pass their wealth to their millennial children, their ungrateful, over-entitled millennial children that lived at home till they were 39. Okay. And the millennials really do take a beating. There's a lot of great millennials. Okay. I wish I was one. I'm a Gen Xer. And so, you know, that wealth is going to be passed. It's not going to evaporate. It doesn't disappear. It does concentrate, sadly, in a smaller number of people. And I think that's terrible for society, but it is what it is. But the wealth is going to just be passed down, right, to the millennial kids. And then they're finally going to be able to pay off their student loans, and they're going to buy bigger, nicer houses, probably not McMansions, because I can't really see millennials with their current mentality liking McMansions. They're just too environmentally conscious for that. And it's like too conspicuous for them, but you know, whatever. I don't know.
No, that we've seen that generation. That's not going to, what we are seeing is a change in values. And I did this research many years ago to determine where I was going to buy all my properties, right? It was a 30-year trend, and it's a change in values going from a consumer society into a more conservative society. And that's, and that's what we're seeing. And when you have those two cycles butting heads, you have a season of depression.
Yeah.
And
and that's the fourth turning, right? The famous book, right? That's what they say is coming in, you know, late 2020s, 2030. But I will remind everybody that if you look at, I love watching old movies, old TV shows, and listening to old music and reading old books. Okay. And if you just remind yourself about the decade of the 60s and think of Woodstock and think of the hippies and all of the hippies who hated the establishment and hated money and the corporatocracy and all that stuff, well, guess what? They became greedy baby boomers, okay? They became the Clintons, okay? And, you know, that's not a good reference, but, you know, they got into money. Okay, the millennials will probably come around. You know, they'll get covetous soon. No, so I don't know.
Point.
We'll see.
Hey Brian. Hey Brian.
Yeah, go ahead.
I was thinking about this. We've talked a lot about a lot of high level things, and there's 10, 12 minutes left, and a lot of high level humans here. And I just wondered how it might feel of a little more like in the weeds as people are listening and who may not be doing hundreds of millions of dollars or, have this level, like just thinking about the actual takeaway here and the next steps and as people are walking away from this conversation, awesome conversation. By the way, Jeff, my wife texted me too, like, where are you at? I thought you were going to be here 20 minutes and I am an hour and a half later because I'm taking notes, people. And if you're not, make sure you come back and watch and listen because there's a lot. But if you don't mind, and again, Brian, you're the man in charge. But I'm just thinking maybe we can give some takeaways. And pardon my dog from.
I thought you wanted to give some takeaways. I thought you wanted to share some stuff.
Yeah. Okay, I'll start.
Some practical stuff.
I'm down to start then. So. Some practical stuff. I know. So the lane, again, for anybody who's just in here, the lane I sit in, I've been a flipper for, I've done about 700 flips over the last 5 or 6 years. We transitioned to new construction and development. And as Jason alluded to earlier, we've been really focused in that build to rent and the building of things that people can actually afford to build, to own. And I sat down with our HBA locally here and they've continued to say, actually, Jason, I'm curious what you say about this, but they're like, we're still 2,500 units a year behind. And my company is one of the only companies building in the sub 500 price point here in Kansas City, which is, lower. Most of those builders are building in that space. And so our focus has been, where are people going to be able to afford? They're going to still want something nice. They like to watch HGTV. They want to have the thing that looks good. Maybe it's 500 square feet less, or maybe it's a smaller lot. But how can we come in and build something that people will want? They want to live in it, but it also is producing, it actually works fun.
Yeah. Yeah, that's what has to happen. Entry-level housing there's such a shortage of it, and it's just getting worse and worse.
Well, think tiny homes. I mean, some people are doing that. I stayed for an Airbnb in a community where I was going to build an affordable housing with these tiny homes, and those are actually pretty nice if you don't need the space. If you just want to, and that's what people are going to gravitate towards. Think in Japan, where they got those tubes, those places you can rent for you just to sleep for the night. In the future, for some people, they'll be happy with that, as opposed to being homeless, or opposed to, So I think people will gravitate being okay with less, like no more McMansions, less luxury, more conservative. And so I think, just make offer great products. But I think, maybe smaller, more closer together, but away from if you're going to build, build further out. Where are you building, Nate? How far from the metro are you building?
Yeah, we kind of hit all we built some in KCMO, but actually, interestingly enough, what they were telling me was in Kansas City, we don't have any of the Lennars and the big home builders here because unlike some jurisdictions, there's like 57 different places you'd have to be able to pull a permit versus, pulling one or two area, just to the city. So we're kind of on the outskirts of the city, but still very much in those kind of developing areas. And we built some in the city itself too, but they're such a pain in the ass to get, permits and stuff. We've really stayed away from that.
Yeah, your particular business model, it's been great. I'd be very cautious going forward. Do some things to protect yourself against things that are outside your control. Things you're relying on that you relied on before that could change. As far as a takeaway for everybody, I know you want to go down in the weeds, but everybody has in different spots. So let me give you everybody, the biggest thing you can do tonight is set a goal on what you're going to do in your real estate business based on what you heard tonight, what motivated you, what your takeaways are, how are you going to use this towards a goal, but you have to have a goal. So think about what you want your real estate business to look like a year from now, or your investments a year from now or 2 years from now, and get excited about that future vision. And then no matter what's going on outside of you and your world, you can do anything. I mean, if you take control, if you take responsibility, if you're flexible and you can pivot and you can get creative, you can do anything you can imagine. So imagine great stuff, and don't let all the negativity of the news or the future or dark future or uncertainty stop you. You use that as a motivator. Just say, there's unknown opportunities. That's one way to look at it.
Richard, imagine ending veteran homelessness this decade, because that is what is going to happen, and I'm committed to it.
Eric, I have a fundraiser. I have two fundraisers I want to talk to you about, and I was looking for what's a good real estate related charity. And homeless vets, I'm a vet. I'm an American. I don't like seeing our money going. I want to take care of our own, right? So I have a very exciting fundraiser so get a hold of me. Let's talk, and I would like to learn more about the organization, because I think I was thinking Habitat for Humanity. I was also thinking of United Way for homelessness in LA and stuff. But this is
stick with the vets, Richard. Let's stick with the vets, man.
Okay. All right, and let's do that tonight, everybody. If you're still on,
you got one right here.
And Jason, what service? What service, Jason? Were you in the service?
No, I wasn't. No.
Oh, I think.
But I appreciate all those who served. I'm just saying you got one right here in terms of a place to donate. Yeah.
Okay. So the donate. So let's push the donations up. If you're still on, donate anything if you haven't donated yet. And what is it? What's the goal? 171.
170,000 we've been raising since basically January, and we're at 131,000. Yeah, as of tonight.
What's the total, Brian?
We're at 131,711.
Yeah, I'd like to add one more thing, and that is if you could take that link and share it on your Facebook for a week.
Perfect. Yeah. When's the deadline? Do we have a deadline?
We're stepping off Thursday morning at 0600, and guys, this is going to be painful. 20 miles a day, 56,000 feet of elevation change over 9 days. That's summiting Mount Whitney 4 times in 9 days.
Thanks for bringing that up, Eric. Thanks for bringing that up.
All dispersed camping,
Mount Everest twice.
There is no water source other than lakes and streams, and there is no campground we're staying in. We will be camping. And the point of this, guys, is if you're still listening out there, is these men and women who are on the streets and looking for housing, who served our country and served this land, they should own as much of America as possible. And my company, Active Duty Passive Income, supports that, obviously. Jason, we've had you on the podcast. Obviously,
you guys are great.
Nathan and
you guys
Brian
are doing great stuff with Mike. Yeah.
And honestly, so what we're going to encounter the next 9 days, starting next week, is nothing in comparison. The pain we're going to go through, the anguish, the backaches, the blisters, and all that stuff is nothing in comparison to what these men and women are going through, and they don't deserve to. So let's get some roofs over their heads.
It's a great cause.
No doubt about it. And Eric, thank you. I mean, we were chatting back in December, and I think, correct me if I'm wrong, you got inspired by some of the hiking I was doing. You saw me doing some hiking, and it's like, well, let's put together something.
Yeah, I'm sure that's exactly where it came from. Yeah, just going, well, let's put together something. Brian's out there crushing it, so I can't hike as fast as you, but hey.
Well, I don't think so. Listen, 9 days. I don't hike for 9 days in a row. So I think we're all gonna be tested. I don't think any of us have any idea.
Hey, as long as you can all keep up with me, you'll be doing good.
Man, a tough 20 miles per day. That is insane for all those days. That is insane.
35 pounds on your back.
Yeah.
Absolutely.
I guess you're gonna film it.
I'm gonna be that annoying guy recording as much as I can, for sure. Just taking pictures.
TV crew following us.
Yeah, right. We've got a drone following us.
How many of you are going again?
Who wants?
Yeah, 12 signed up for various reasons. One couldn't make it. Another one had an injury. So I think we'll have 9 the morning we step off. Yep.
That's amazing.
One woman on the trip.
Yeah. And isn't that your daughter?
Yeah.
It's going to be very interesting to see.
Stay safe, you guys. Stay safe.
It's going to be fun. No, Eric, we haven't even really, thank you for sharing, obviously, everything that you've shared just about the cause, but you haven't even really talked about your company and talked about what you do. We've got maybe 2 or 3 more minutes here. Let's kind of wrap up this way. I'd love you to kind of share a little bit more about yourself and your company and kind of put a bow on this evening.
Yeah, sure. So I'm a co-founder of Active Duty Passive Income. To put it quickly, we're basically the bigger pockets for military members. There's a complete blue ocean of lack of education for military members. And we started off with our #1 best-selling book, and now we have, which is called Military House Hacking. We have education courses. Just listening to our community of 55,000 members now. We have a mortgage company, an insurance company, a real estate brokerage, and just everyone telling us, hey, you guys are the best. We need this. And that is, my boys are coming in from the park. Sorry. So now we're just at a point where it's exponential growth. Military. So breaking down barriers to military members is what we always do. We're an education company and community at heart. And what's amazing about it is that when our 55,000 members speak, we listen. And you guys, some of you will understand this. You see a lot of Reg D 506C and Reg D 506B syndications, and I do those as well as a general and as a limited partner. But what you what that means to a veteran, a lot of times you either have to be accredited or you have to know somebody who's doing a 506B, that, you know, friends and family type of deal. But you also, most of the time, have to have around $50,000 to invest as a limited partner to get into those. So what we did with ADPI Capital is started a Reg A fund. And now our veteran community, and anyone really that's 21 years old and a U.S. citizen, can invest as little as $500. So you can go to adpicapital.com and invest with the military community. So think of a young E5 or you know, sergeant, if you're not familiar with the pay grades. They don't have $50,000, but they got $500, and they can start doing that monthly if they want to. And we're going to be providing some amazing returns. And another thing we've done is eliminated all of the fees that a lot of funds have, that you hear out there, that people are getting a 4% return when they were promised 8% preferred return or whatever. So we're going to crush it for the military community. That's just another thing we added on there. We knew we could do it for them, and just breaking those barriers down. So that's me.
Eric, thank you.
Awesome.
Passionate.
Guys,
from how fast I'm talking, you can tell I'm passionate about it.
Well, listen, when you put together what you just put together, like having 12 people sign up to do a hike, to buy into your vision, and this kind of goes for anybody who's listening. If you have passion with your purpose, with who you are and what you are, and this is the quality of a true leader. This is how you get other people. When you get other people to buy into your vision, like you've gotten 11 other people to do that, to hike 170 miles with you in 9 days, which is pretty crazy. But not just that, but to raise the money, not just that, to actually do things and be involved. That's true leadership. And we just appreciate you. Everybody on this call. Again, this call does not exist without Eric and his leadership and all the men and woman who is going to participate in this incredible hike. So we appreciate you guys so much. Jason, Hartman, thank you so much for the data. Thank you so much for your time. I was going back through our messages and our emails because I had to find your email address to send you this link. Right. And we were trying to schedule a podcast 4 years ago. And
oh my God, it's been 4 years.
so we need to make that happen. We need to do a podcast for sure.
After you get back from the hike.
Yes, for sure. Ed, I'm going to see you soon. Nathan, same thing with you, man. We've been trying to schedule a podcast as well. We need to make that happen. Jeff, I'm so grateful for you. You've been to Birmingham because of me. What, 3 times, 4? I think maybe 4 times, 3 times. And and you've been on my show, my podcast, I think 3 or 4 times as well. And your knowledge is just off the charts. You even wrote me a letter of recommendation to get into law school, which I got accepted into. And I'm so
When do you start? When do you start school?
The fall. So anyway, so grateful for you. Thank you for coming on and providing your wisdom. Richard, I haven't known you for very long, just maybe a year and a half, and just a little bit of time we've known each other. You're a wealth of knowledge. I'm so grateful for everything that you've done to help me, help my audience, help all our folks, especially here in Birmingham. And you're going to be speaking at our coaches conference, so I'm super excited about that. And then obviously Eric, and for everyone who was on here earlier, you started talking about Tim Bratz, Mark Evans, Joe McCall, Joe Evangelisti, and Gabe Garcia, Tag Thompson, and I'm forgetting some, so please forgive me. But for all the ones who were on here earlier, these folks donated, not just that, like a lot of them donated to the cause money. They donated their time. These are people who are like multi-wealthy, multi-millionaire wealthy people that have no business doing something like this, except they know me and they like me and they like the cause. And that's it. And for that reason alone. But I want to give a special shout out to them. Barry, I don't know how to say your first name, but last name Beato. Jason, thank you for your donation. Mark Evans, Gabriel Garcia, Ken Joslin, Joe Evangelisti, Bratz, all the folks who, and I promised Billy Alvaro wanted to be here tonight, but he couldn't make it. And I told him I'd give him a shout out. Billy, thank you for your donation as well. For everybody, and I know I've been long-winded here, but I'm just so grateful for everyone who's donated and everyone, not just their money, but just their time as well. So thank you guys so much for a great evening. The replay is going to be on YouTube, and it's actually on there now. So as soon as I end this, the replay will be there. I'm going to send that out to everybody. Hopefully people are going to watch the replay. and they're going to donate off the replay as well.
Yeah, we should
So,
all share the replay. Everybody share the replay.
yeah. So
Agreed.
guys,
And thank you, Brian, for doing this. Every dollar counts, and you're the man for putting this together so quickly. So appreciate you.
awesome guys. All right.
Good job.
We
Brian.
appreciate y'all so
Thanks,
much.
guys.